Why did the stock market crash hard after Jerome Powell of the Federal Reserve Board announced a 0.75 interest rate increase? What investments have helped me profit during this crash of the fake bear market rally? What is in store for the future of this roller coaster market? This is not financial nor professional advice. This video is for entertainment only. Hey everyone, Jerome Powell of the Federal Reserve Board really socked it to us on November 2nd, Tuesday. He not only said that they were going to raise it 0.75, but that this was not their ultimate goal, that the focus should be on not on the journey but on the destination, and they are going to keep raising the rates until there's maximum pain, and they're not done by a long shot. And one very revealing moment when he was being interviewed after the announcement was a reporter led him to believe that the market was going up. The market was actually going down, but he inferred from the question that the market was going up. And so Jerome Powell started giving all the hawkish reasons why the Federal Reserve was just going to keep raising rates and would not quit. And so it just became an impetus for the market to start crashing, and crash it did, and it crashed hard. I had gone into the week thinking that I was going to invest in healthcare stocks and defense-related stocks, but they really didn't move much. And when he announced this, the market started crashing with such intensity that the only thing to do was to get out of those and to jump into my old friend SQQQ, the triple leverage inverse fund on the 100 largest stocks on the NASDAQ, and also on DRV, which is the triple leverage inverse stock on the real estate index. And that index, the DRV, had been going down, and housing looks terrible. The statistics are terrible. It should be going up because it's an inverse fund. DRV should be going up when real estate is doing terrible, but it was doing just the opposite. But when I heard this from Jerome Powell, I piled back into SQQQ and to DRV, and I made up for whatever losses I had from the previous couple of days, plus more. And that's been the story of this year. I always make it up on the shorts. I'm going to keep shorting, and I'm going to keep myself from buying stocks at this moment. So the moral of this story is the Fed is not going to pivot. They're swiveling to a new reality. And that new reality is what I will call, it's sort of a boom session. It's like a jockey trying to hold. If the economy is a horse and investors are the jockeys, or the Fed is the jockey, it's trying to hold the horse back, from which is a very spirited horse, and it wants to run forward, but you have to keep control of the horse. And so the Fed's going to keep control of this horse, the economy, by keep raising rates, and they've promised to do that. We've gotten a promise of unlimited rates until inflation goes down, and we need to listen to that message. This is not a time to invest in stocks. This is a time to short stocks. And I'm using triple leverage stocks. SQQQQ is my love of my life. It's made me more money than anything. DRV is going to come back because housing is crashing. And I have some others that I'm going to go into. That bear market rally that we had recently is the Federal Reserve's nightmare, because that that was that was their horror show. That is the worst thing that can happen, is for the stock market to explode upwards when they're trying to control inflation. Because what that is a melt up. The stock market is going up, and the Federal Reserve is going to chase it, and it means they're behind inflation and they're trying to catch up. So they're going to have to keep inflating the interest rate increases. I wouldn't be surprised if it was 0.75 next time. We expect 0.50. But he's saying, quit focusing on how much or how little I'm going to increase it, because once I get it increased, I'm going to keep it there, because our ultimate destination is much higher than we thought it was going to be even a few months ago. So we're in a ride where the stock market cannot really go forward, and it's more likely to go downward. And the Jerome Powell and the Federal Reserve Board will be having a party if the stock market crashes. They will be happy. And as bad as it sounds, and as horrible as it sounds, they want more job losses. And let's go into that. The ADP report came out recently regarding employment, the jobs report, and it showed that we had gained 239,000 jobs. The Federal Reserve wants to see us lose jobs, or at least the additions of jobs slow down considerably, which it hasn't really done. But more important than that was the annual pay raise increase was 7.7%. Now, this is showing the beginning of a wage increase spiraling upwards, which is the last thing they want to see. And as the Federal Reserve has acknowledged, once it's clear, it's not exactly clear that's happening. We see the beginnings of it, but once it's clear that it's happening, it's too late and it's very hard to stop. So they want to put the brakes on this. They want to slam the brakes on the wage price spiral. The JOLTS report, which is the Job Openings and Labor Turnover Survey, was also distressing to the Federal Reserve, as there were 10.7 million jobs opening. It was expected, it was predicted that there was going to be like 9.85 million jobs opening, and that would be a reduction in what there had been, but instead it jumped up almost 900,000 jobs more than they thought. The manufacturing sector has also been giving the Federal Reserve nightmares. And this is so bad, because good news is bad news, because we're not, what they've realized earlier than I realized, I thought we were going to go into a recession. No, they're fighting hyperinflation. That is really what we're fighting. And so the battle is inflation, and to just put some backward pressure on this economy, it's probably not going to go into recession. The Atlanta Federal Reserve is predicting that the fourth quarter GDP is going to be 2.6%. So we're coming out of the technical recession, and we're not into a recession. We are now fighting hyperinflation, and I think the Fed has gotten it right, and they're doing the appropriate thing. And like he says, the risk is not that they're going to raise rates too much. The risk is that they will do it too little. And so they've got to stay in the fight and be consistent. And I think they're going to raise rates for the foreseeable future. The manufacturing PMI also came in at 50.4. If it's over 50, that indicates that the manufacturing sector is expanding, which is the last thing the Federal Reserve wants to see. It was expected that they were going to contract somewhat, that they would come in at 49.9, but instead it expanded to 50.4. So the Fed is not liking what they're seeing. They're going to chase down this inflationary melt up, and that's what we have. And if they didn't do this, our currency would literally become a joke. That, you know, the prices, you would make more money in the stock market and so forth, but everything would cost you so much more. So it's especially hard on the lower 80% of the country. The top 20% that have lots of assets and investments would do well, but the bottom 80% would do poorly. So you can't have that. And they tried to bring the two sides closer together so that there isn't such a disparity in the country, which has been the problem for a while. And so the bear market rally, which should have never occurred, there was no reason for it. It was insane. Okay. And people keep thinking about the Fed pivot. I am so sick of hearing the Fed pivot. If he even whispers a word that they could possibly decrease rates in the future, the Fed is pivoting. It's literally insane. He cannot utter the word that they're thinking of pausing. And he went overboard and saying over and over, we're not pausing, we're not pausing, we're not pausing. We're going to increase, we're going to increase, we're going to increase. Do you hear that yet? And he's been saying this for months, and it doesn't have any effect. And so he keeps having to raise the interest rates because the stock market doesn't believe him. Well, we believe him now, I think. Jackson Hole, you think they would have believed him after that? He more or less said this is the case. But he had to do the same thing. He had to go overboard. And we got the switch, and I jumped back in as soon as he went hawkish. You know, the worst possible thing he could do for the stock market was to announce the 0.75 increase and then to be super hawkish. And he did both. He wants us to go down. He doesn't fear recession. Recession means nothing to him. He knows it's an inflationary nightmare, that we could have a super melt up where people with assets could possibly benefit. But the people that are in the bottom 80%, the majority of the country, would suffer indeed. And so he had to go and he had to hawk. And doing this, he had to do this even after the major fangs, Microsoft, Google, Apple, the Amazon, Meta was the biggest fang dive last week. He shouldn't have had to say anything. The stock market should have been getting the message, or have it knocked into their heads, that we're going down, folks. We're not going to stop this train. It's a freight train going down. And I think we finally have gotten to that. And so I returned to my best friend, SQQQ, the 100 largest companies on the NASDAQ. It's the inverse of that. So when those big mega stocks go down, SQQ goes up. And it's somehow, some way, the bear market rally occurred, which made no sense, which is going to make the crash worse, and which is going to make interest rates go up worse. And so I'm going to stick with SQQQ at least for a while. We will see what happens. DRV is the triple leverage inverse fund on the real estate, and it's been struggling recently with the rally. Again, it made no sense. Last month, home sales went down 10%. Interest rates on mortgages are over 7%. Tell me how this makes sense that the real estate index went up. Okay. And now he's going to raise the interest rate, which will translate much more to mortgages. So I think DRV is a solid investment, and I think I'm going to hold it at least for a while. But you never know in these crazy markets. They make no sense in some sense. I think they might start listening to Jerome Powell. I think the message is coming through clearly, so I think there's money to be made in DRV. The other triple leverage inverse fund that I think is investable is SOXX, SOXS, which is a triple leverage inverse fund on semiconductor stocks. And I think they're almost certainly likely to go down, especially with the United States putting limits on what semiconductors can be sold to China. And China is in a mess. But let's look at their fund for a while. This is not financial advice, but this is simply the triple leverage inverse funds that I've been dealing with recently. And Yang is a triple leverage inverse fund on Chinese stocks that trade on American stock exchanges. And it had a big leap upwards and then another leap, but then it's come back down to its normal level. And I think the reason it came down recently was because China is thinking of reducing their zero COVID tolerance policy, that they're going to quit doing so many lockdowns. And so if that happens, China will go forward more than they have been and won't be in nearly as bad a situation as they are in. So good news for China is bad news for Yang. So the recent good news makes Yang it's not at the top of my list. I'm not in it. I got in there and got some gains and happily got out. I took a little bit of the loss, but I had already gained so much that I came out positive. So I was happy about that. That's the way I roll. These are wild days in the stock market, even wilder when you're doing triple leverage. But I'm doing a small amount, but I'm triple leveraging it, and I'm keeping a large portion of my investments in cash for now, hopefully to let them grow a bit because of the increased interest rates. And then hopefully once they actually start pivoting, when they actually start saying we're going to reduce the rate, that's when I will start investing again heavily. But for now, it's mainly staying in money markets and doing triple leverage inverse funds to get my kicks. Okay, I get my kicks on these triple leverage inverse funds because you can make a lot of money. But again, I'm taking it easy as far as how much I'm putting into them. Thank you. Be sure to smash the like button. Be sure to subscribe if you haven't done that already. I hope to see you in the next one. Take it easy in these turbid days.